Our next segment is credit. What is credit? We're going to take a look at what credit is, how you use credit. We're going to describe the role of the credit bureau. Most of you have heard of a credit score. I'll discuss the FICO score, which is one version of a credit score with you. And we'll talk about how to increase that credit score so you can get the best price when you're borrowing money. You also need to understand the different types of credit. There's different types of credit out there. We'll talk about the different types of credit and which ones are easier to obtain and which ones might be a little farther down the road for you. What is credit? How do I get credit? Do I need credit? Things we're going to talk about here under this credit segment is what is credit? We're going to describe the role of the credit bureau and the credit bureau report. You will understand the FICO score, or credit score as it's often referred to. And we're going to talk about different types of credit and how do you get that credit. So let's answer the first question. What is credit? Credit is an arrangement to receive something now and pay for it in the future. Credit is often referred to as consumer credit. Consumer credit is any credit other than a mortgage. We generally look at mortgages a little bit differently. We need to talk about the cost of credit. I just define credit as an arrangement to receive something now and pay for it in the future. Unfortunately, you have to pay for the credit. So you're paying for whatever it is you receive, goods or services, in the future, but you do pay for the credit now. Credit can be expensive, depending on the type of credit you're using. However, credit definitely makes it easy to buy things. If you don't have the money right now, but you have credit, you can go get whatever it is you want or need. Unfortunately, credit negatively affects our ability to save. Because as I stated, you're going to pay for it in the future. If you're paying for it in the future, where does that money come from? Have you budgeted to pay the credit? Or are you going to have to change the budget in order to find the dollars to pay for that item in the future? The credit bureau. The credit bureau collects and shares your credit information. So merchants are providing them information. Lenders, creditors, are getting the information from them. There's three primary companies: TransUnion, Experian, and Equifax. They each keep their own information. So if you look at one credit report, it may not have all of your information on. Different reports can have different information. So when someone is analyzing your credit and trying to determine if they want to extend credit to you, they may not see the same information you see. If you look at your TransUnion credit report and they're looking at an Equifax credit report, there may be some differences there. Hopefully they're the same, but not necessarily. You're entitled to an annual free copy of your credit report. So you can review it, make sure the information is accurate, and try to make sure the information, you have some say in what gets on there. You can provide information to them. I don't like that. Let's talk about credit. What is credit? Everybody hears about using credit. We talk about credit bureaus. What role does the credit bureau play in your credit? We'll talk about the FICO score, or your credit score as it's oftenly referred to, and talk about what you can do to help that. And we'll talk about different types of credit and how you can get that credit. So the first question we need to ask ourselves is, what is credit? Credit is an arrangement to receive something now and pay for it in the future. That's based on your ability and willingness to pay. Consumer credit is any credit other than your mortgage. We treat mortgages separately, and we're going to focus here on consumer credit. The cost of credit. I said credit is an arrangement to receive something now and pay for it in the future, but there's a cost involved. You're paying for it in the future, but you're also paying for the credit. Credit can be expensive. Depending on the type of credit, it can get very expensive. However, credit makes it so much easier to buy things. We can buy things that we normally wouldn't have bought if we didn't have the credit. On the other hand, credit negatively affects our ability to save. Because as I said earlier, you need to pay for the credit and you need to pay for it in the future. So when you pay for it in the future, where does that money come from? Can you find that money in your budget? Or are you going to take it from one of those other categories and pay for it that way? If you're taking it from that other category, we're going to be coming up short. What is the credit bureau? The credit bureau is an organization that collects and shares your credit information. There are three separate companies. There's TransUnion, Experian, and Equifax. Those three companies all track your credit information, and they provide that information to creditors when they're looking to make a decision on whether or not they want to extend credit to you. Because there's three different credit unions or credit bureaus, you need to make sure that they contain accurate information. One credit bureau may have information that another one doesn't. If that's positive information, you'd like to see it on all three of them, but there's not a whole lot you can do about that. If there's negative information that may not even apply to you, you do have rights. You can get a copy of your credit report and let them know of any inaccuracies, and they need to investigate it at that point. I said they collect your information. They're collecting it from other creditors who are submitting your information about your payment history and what credit you currently have. The credit bureau consolidates all that information, so the next person wanting to extend credit to you can see that information. So you can get an annual free copy, and the website I recommend is www.annualcreditreport.com. You go online, and they will provide you with a copy of your credit report. It doesn't matter which one of those three companies you get a report from. But if you really want to monitor your credit status, you should only get from one company. Why one company when there's three of them? Because if you need to make any corrections, you can then get another from a different company 3 or 4 months later. That actually gives you 3 times throughout the year to check on the status of your credit report. So what's all in this report? There's your payment history. How have you handled your payments? Are you paying on time? All of your available credit is listed. And why available credit? Because if you have a lot of credit, even though you're not using it, you could be put in a position where you were overextended by using all of your available credit. And that's past and present. So you may have accounts that are closed that will show that if you've had good payment history, that's a great thing. If you've not had such good payment history, that can work against you. Generally, it'll be on your report for about 7 years. So what types of things can work against you? Late payments, any public record information such as bankruptcies, foreclosures, liens that have been filed against you. One thing you got to keep in mind with the payment history, if you skip your January payment and make that payment in February, you're 30 days late. Now that counts as a January payment, and you're missing a February payment. So when you make your March payment, that counts as February's payment, but March is 30 days late. So by missing one payment, you continue to add up those 30-day delinquencies. Now we run into some hard times, we miss another month, now we have a 60-day delinquency. So if you have a delinquency, the only way to stop that number from growing is to catch up and make those back payments. So you got to be careful with your payment history. Employment information. Why do they care about your employment information? Well, some of this information will be there, could include your salary, or at least the last information they have on salary, how long you've been employed, where you're employed. They'll gather information about your home situation. Where do you live? They'll have your address, your social security number. They'll know whether you rent or own. They may even know, based on credit applications, how much you're paying on a monthly rent. Or if you have a mortgage, they probably have that information already. You got to remember, it's your responsibility to correct the information. So if you find inaccurate information, you need to correct it. The credit score has become a common term that people use. Unlike the credit report, which you get a free annual copy, free copy or free scores are not provided. The FICO Score is a Fair and Isaac company created a score, and what they did was analyze credit reports and came up with a numerical rating of your credit report. The FICO Score can actually range from 350 to 850. The higher score is better. Score of 700 plus is considered good. Lower scores may result in a higher cost of credit. Or on the other end, high scores may get you a discount on your credit rate. Now I'm referring to the FICO Score. There are other credit scores out there. There's a Vantage Score. The FICO Score is probably the most common. So that's why I'm referring to that. The FICO Score is, how they calculate the score is considered a trade secret. Nobody really knows. But there have been studies done, and there are some factors that definitely appear to be considered. Your payment history. Remember I talked about those delinquencies? Whether or not you can pay your debt is going to have a huge impact on whether or not people are going to want to lend credit to you. So your payment history is a huge factor. The amount of debt you have will be a factor. The length of your credit history. How long have you had credit? Here's one of the factors that you may want to keep in mind if you want to improve your credit score or not hurt your credit score. is by not getting rid of that credit card that you've had the longest. That established when you first had credit history. By eliminating your oldest credit card, you have shortened your credit history. Types of credit. We're going to talk about some different types of credit. The more types of credit you have, the better that's going to help your credit score. Inquiries. Inquiries are how many times a creditor has checked your credit report. Why would inquiries matter? Because if there's a lot of people checking on your credit, that would imply that you're trying to get additional credit. Why are you trying to get additional credit? Might there be some credit in the process of being approved that's not yet on your credit report? So a lot of inquiries can actually lower your credit score. What can you do to raise your credit score? Question that gets asked all the time. If you look at those 5 factors, the payment history, your debt, your length of credit history, types of credit, and inquiries, take care of those items and your credit score will continue to go up. By the same token, have one problem and your credit score will start dropping. So I talked about types of credit. Let's look at a couple of different types of credit. The first and probably the easiest type of credit to get is a credit card. Credit cards make credit is where most of us use our credit. When I talk about credit card users, I talk about 2 types of people. We have convenience users and we have borrowers. A convenience user uses that credit card simply because it's easier to pull a credit card out of the wallet and slide that through the machine than it is to carry the cash. If you're a convenience user, you may be using a credit card to earn points on your credit card for airline miles or some other convenience that is offered as an incentive to use your credit card. If you are a convenience user, that means you're using it out of convenience and, more importantly, paying it off every month. Pay off the entire amount of credit and you actually don't have to pay for the use of that credit. As opposed to a borrower who can't afford what they want to buy, so they're borrowing on their credit card, not paying it off, and each month they're paying the finance charge or paying for the use of that credit. When we talk about credit cards, there are bank cards and there's merchant cards. Bank cards, Visa, MasterCard are 2 examples. Merchant cards would be your Kmart card, your JCPenney's card, a gas station card. Cards that can be used at specific merchants. Merchant cards are usually the easiest way for someone to open a new line of credit. Oftentimes you're at the store, they'll offer you a discount if you get their merchant card. That is a type of credit. Once you have one type, other types are easier to get. So if you're trying to build your credit, raise your credit score, a merchant card may be a way to go as long as you remember what it means to be a convenience user. An unsecured loan. Depending on your credit, this may or may not be available. An unsecured loan would mean you go to the bank and ask them to give you a loan. Based on my ability to pay, I would like to borrow some money. They're going to check your credit. They're going to determine whether or not they feel it's a worthwhile, risky adventure, and they'll decide whether or not they're going to issue credit to you. Fairly risky for the lender. We also have secured loans. The secured loan is where the lender has collateral. Collateral is what they would take if you stopped making payments. On the unsecured loan, there's nothing there. If you stop making payments, the bank loses the money, or the lender loses the money. On a secured loan, there's collateral. You have offered something up in the event that you stop making your payments. Because they have the collateral, there's less risk. That collateral could be your car on a car loan. It could be your car on any loan. If you stop making payments, they then have the right to take your car, sell that to pay off the loan. So there's less risk involved in a secured loan. I told you mortgages are not considered consumer loans, but that would be another type of credit. A mortgage is going to be a huge amount, less risk, because you're buying a house that is going to be worth more than the bank is going to allow. But because of the large amount, it's not necessarily an easy type of credit to get. So we've looked at different types of credit. How do you get that credit? Obtaining the credit. Credit card, apply for a credit card. I mentioned merchants often offer the credit cards right at the store. Bank cards, you may get solicitations through the mail, or you can stop at a bank and fill out a credit card application. The unsecured loan, talk to your financial institution. Depending on your situation, that may or may not be an option. The secured loan, there's collateral there. Talk to your financial institution or the company selling the product. See where you can get the best deal, the best rate or cost of credit. If you're buying a car, the dealer may offer financing, your bank may offer financing. Who's giving you the best deal? You need to do some research and find out where you can get the best deal on the secured loan. A mortgage, you're going to have to apply through a financial institution. Now, that's how, once you apply, how do they go about evaluating your credit worthiness? The first thing they're going to look at is your capacity. Can you repay the loan? Do you have the ability to repay the loan? Your character. How do they measure your character? A lender will look at your character based on your payment history. Do you pay your bills on time? It's a good indicator of your character. If you've paid your bills on time, they're going to have a greater likelihood of being approved for credit. They'll look at your collateral. Can you secure the loan? If you have the security or the collateral, it's easier to approve a loan because there's less risk involved. They'll look at your capital. What assets do you currently have? Do you have savings? Do you have a retirement fund or investment account that if everything went south, you could cash that in to pay off the loan? Then the last factor companies look at are the economic conditions. Economic conditions may affect your ability to pay. You could have the capacity to repay, you could have no delinquencies, great character, you're offering collateral, you even have some capital that you can additionally secure the loan with. But based on the economic conditions, financial institutions may not be lending. So banks are looking at these characters or characteristics to determine your credit worthiness. The last thing I want to talk about with credit are open versus closed lines of credit. An open line of credit is it's an available line of credit. It's always available for you. It's there as needed, and once you need it, you set up an installment plan. A credit card would be a good example of that. You may have the capacity to repay right now, but if they give you a line of credit for some time in the future, they're probably going to be a little more restrictive on that, as opposed to a closed credit, which is a one-time amount that you set up on an installment plan and pay the loan back. typically how car loans, most bank loans are set up that way. So you've got the closed credit where they can look at these characteristics and make a decision today. We also have open lines of credit where lenders are going to be a little bit more restrictive. Now that we've talked about credit, I would encourage you to go to one of the websites, annualcreditreport.com, and order a copy of your credit report. Take a look at it. Make sure it's your information and no one else's, and make sure the information that's there is accurate. Mistakes are made on credit reports. We don't want to have any of you paying the price for having a mistake on your credit report. Do what you can to keep your credit score high. Over the course of time, it will continue to work its way up as long as you manage your credit. Remember, if you're going to use credit, be a convenience user, not a borrower.